Welcome to Outlook 2026 Blowing Bubbles. The biggest question on investors' lips as we head into 2026 is whether equity markets in general, or the AI theme in particular, are in a bubble. We are of the view that they are not, and believe the rally is backed by strong earnings and cash flows. However, elevated valuations mean there will be significant swings in sentiment along the way. Let's dive into three key themes that we believe will shape the year ahead. The first theme is stock market optimism and the persistence of the AI theme. While valuations are elevated, tech sector earnings continue to rise sharply, a key difference versus the bubble of the late 1990s. And therefore we believe the tech sector rally still has legs. Fed rate cuts and a weak US dollar are consistent with positive returns in risky assets. We are not ignorant of the risks presented by elevated valuations. The difficult balance for investors, though, is to find a way to stay invested, but also manage the risk of valuations making markets excessively sensitive to any disappointment. To balance this within equities, we have two approaches. First, diversify regionally. We remain overweight US equities relative to global equities, but balance this with an overweight to Asia ex-Japan as well. This offers exposure to our weak US dollar view, domestic policy stimulus, especially in China and India, and equity exposure at more moderate valuations than are available in the US. Second, diversify sectorally. We balance an overweight to US technology by having an overweight allocation to US healthcare and utilities sectors. While utilities have some overlap with AI via demand for energy, it remains more defensive in nature. And the healthcare sector is also expected to benefit from a reduction in regulatory uncertainty and inexpensive valuations. Putting this together, we believe that this approach allows investors to remain invested in the US tech sector while diversifying to broader sources of returns across regions and sectors. The second theme is the appeal of emerging market bonds. Whether denominated in US dollars or local currencies, these instruments are offering yields that are hard to ignore. They also provide a valuable source of diversification. So why are emerging market bonds so compelling in 2026? Well, they stand out to us in three ways. First, attractive credit quality, and that's most visible in improving fiscal fundamentals. Two, a higher yield relative to developed market bonds. And three, diversification to non-US dollar bonds, which also provide exposure to rate cut cycles amid falling yields in many emerging markets. The third theme focuses on diversifiers. Gold remains a classic safe haven, and we believe it is poised to continue its upward trajectory in 2026. Consider incorporating other diversifiers such as private assets, hedge fund strategies, and digital assets into your portfolio as well. By layering in these diversifiers, you position yourself to benefit from both growth and stability. As we look ahead, both optimists and pessimists have their arguments. Optimists believe strong earnings, high credit quality, and supportive policies will keep equities on track and drive returns across asset classes. On the other hand, pessimists warn that persistent US inflation could limit policymakers' ability to support growth, driving up bond yields and hurting equity markets. We believe optimists are likely to prevail. Whatever happens, 2026 promises to be an exciting year, and by focusing on the powerful themes of equities, income, and diversification, you can thrive amid talk of a bubble. Thank you for your time. Please tune in to more Outlook 2026 videos to help you navigate your wealth journey with clarity amid global shifting currents.